Welcome to our weekly intelligence briefing, brought to you by Zero Deltas. We are entering an environment of extreme caution. Over the weekend, an unprecedented military escalation in the Middle East has completely rewritten the script for the week ahead. With targeted actions fundamentally disrupting regional leadership, we are looking at massive immediate liquidity shocks. Prepare for wild volatility, specifically in crude oil and gold, which we will break down later in this video. Even before this weekend's news, equities were taking a hit. Inflation came in hot, the private credit market showed cracks, and the Dow hit a 3.5-week low. The flight to safety had already pushed the 10-year yield down to 3.96%, and that flight to quality is now going to accelerate. This brings us to a massive anomaly we spotted before the weekend. Did someone have advanced warning of the strike in Iran? Looking at the Friday end-of-day options matrix for gold, we saw a sudden, massive spike in out-of-the-money call option buying. The volume was heavily concentrated. At the 5,400 call strike, we saw over 2,700 call contracts trade across near-term expiries, including a massive 1,271 contracts in the 25 days to expiration line. The 5,300 strike saw a similar aggressive flow, with over 1,700 contracts trading. This buying panic triggered an immediate impact on price, forcing gold futures to violently spike 20 points in late trading, ripping from 5,278 to test almost 5,300 right before the bell. What does this mean for next week? As gold inevitably gaps higher on this Middle East news, whoever was on the other side of those trades, the institutions short those calls, will be caught completely unhedged. To protect themselves, they will be forced into the market to buy gold futures, potentially triggering a brutal gamma squeeze. Similar to gold, the crude oil options market is flashing massive warning signs of a targeted geopolitical event. Looking at the WTI crude matrix, there is an incredible concentration of call buying at the $67 and $70 strikes that took place on Friday. We are talking over 5,200 contracts at the 67 strike, and a total of 9,600 contracts at the 70 strike, with 7,200 contracts expiring in 16 days, and almost 1,400 contracts expiring in just one day. The 67 strike saw huge block buying across multiple expiries. This wasn't standard hedging. This was aggressive, directional flow anticipating an immediate supply disruption. And you can see that panic start to hit the actual commodity tape on Friday, as crude oil futures bottomed out at 66.96 intraday, before violently reversing and ripping back up to 67.42 in the late session. If this Iranian conflict escalates and directly disrupts supply chains, those calls are going to be completely in the money. The market makers shorting those options will be forced into a massive short squeeze cycle, squeezing crude prices significantly higher. While there are other events transpiring in the market, such as cracks in private credit, tech divergence, and hot wholesale inflation, we are noting those events strictly for information purposes. Given the severity of the weekend's news, all eyes will unequivocally be focused on the unfolding events in the Middle East. If you are able to stand aside and preserve capital during these upcoming sessions, that may be the best move. Keep a close eye on volatility and rising risk indicators, such as the VIX, or the implied volatility on the options chains we just discussed, especially focusing on the 50 and 25 deltas. If you are brave enough to be selling options in this chaotic environment, we would advise not to short commodities but rather to look for opportunities in specific equities. Thanks for watching Zero Deltas, and may the market gods smile upon you.